This series of the 2025 50 Faces podcast is supported by Eagle Point Credit Management. Eagle Point Credit Management is a specialist investment manager principally focused on income-oriented credit investments in niche and inefficient markets. Currently, they believe that Eagle Point is the largest investor in CLO equity in the world and one of the largest non-bank lenders focusing on providing financing solutions to credit funds. This series is supported by Benefit Street Partners. Benefit Street Partners is a leading global alternative credit asset manager offering clients investment solutions across a broad range of complementary credit strategies, including direct lending, special situations, structured credit, high-yield bonds, leveraged loans, and commercial real estate debt and equity. As of December 31st, 2024, BSP Alcentra had 77 billion of assets under management. Our next guest cycled through careers in football financing, film financing, and family office work, and now is focused on the areas of angel investing and small and mid-cap investing within the UK. Hear from him why this kind of investing is so critical to the UK economy, and above all, the importance of trust. I'm Aoife Devitt, and welcome to the 50 Faces podcast, our podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm delighted to welcome Daniel Gore to the podcast today. Dan has dedicated his career to private markets, building a wealth of experience across a range of alternative investment strategies. His impressive journey includes starting out in angel investment to focusing on private equity, venture capital, and hedge funds at Lord Sainsbury's family office. Dan went on to co-found Orthogonal Partners, a boutique asset manager specializing in innovative next-generation alternative strategies, such as patent infringement, film finance, football finance, various specialty credit investments, as well as catastrophe insurance and others. Most recently, he led Stafford Capital Partners' private credit program. Today, he serves as a strategic advisor to Darwin Alternatives, where he is pursuing exciting opportunities within the UK's SME market. Dan, it's a pleasure to see you here. Thank you for joining me.
It's a privilege. Thank you very much for having me on.
Well, let's start with your background and how you made it into this world of first angel investing, but investing as a whole.
Well, I grew up in Finchley in London, and I still live in the local area. I attended the local state comprehensive school and then went on to read politics, philosophy, and economics at New College, Oxford. I didn't really have a career path in mind at uni, but ended up finding myself working for two incredibly sharp entrepreneurs right at the peak of the dot-com bubble. They were focused on angel investing as well as corporate finance work, and they also funded indie films, and I got heavily involved in that piece of the business. It felt like a really great time to be starting my career, to be honest. London was buzzing. Dot-com companies were providing endless drinks parties, and it just was an overwhelming sense that there was an abundance of money. Everything felt really great and positive, and then overnight, the bubble burst. And the entrepreneurs turned around and decided to close the office, and I was forced into a career pivot. I decided to take some time out, do a bit of traveling. So I went around Southeast Asia, South America, and then came back and desperately needed a job and saw an opportunity in the FT and ended up joining Lord Sainsbury of Turville's family office, working as part of a 4-person investment team where we managed a global multi-manager, multi-asset portfolio. A key influence there at the family office was the chairman, Christopher Stone. He was a bit of a pioneer, having embraced the endowment model very early. So we had a really heavy focus on alternative investments, particularly private equity and venture capital, and that's where I really focused. I think it's fair to say that David Svensson, the former CIO of Yale, was a big influence on the approach to investment at the family office. And his book, Pioneering Portfolio Management, was compulsory reading for all members of the investment team. The book made a big impression on me and has influenced my general investment philosophy. I took a lot of lessons away from that book, including focusing on the importance of asset allocation as a key determinant of long-term investment performance, as opposed to stock selection or market timing. That one should diversify away from public equities and bonds as much as possible and instead focus on alternative investments where you can potentially generate alpha and exploit inefficiencies in less liquid markets that tend to persist. And be prepared to invest in unconventional areas and niches, willing to target areas that are generally misunderstood and under-researched, and try to avoid crowded trades. Be willing to embrace complexity and illiquidity for superior long-term results, all of which should enhance portfolio return and at the same time reduce portfolio risk.
Was that family office, did it have any particular orientations, say values maybe that they wanted to implement or impact they wanted to create? Was there any kind of niche that you found yourself focusing on?
There were some niches, but I wasn't focused on those. I had a more generalist role. But I think the team that was working there, we knew that we were actually contributing to something bigger than just generating returns. Lord Sainsbury has been very public in his belief that he wants to give away a lot of money to charitable events. And he's actually created the Gatsby Foundation back in the 1960s and has handed the Gatsby Foundation about £1.5 billion. So we knew that whatever we were investing in and generating returns was ultimately going to those charitable endeavors. So that gave us a great purpose.
What is the Gatsby Foundation? Can you tell us a little bit about that?
The Gatsby Charitable Foundation, it has several different areas that it focuses on. One is in developing Africa and some projects in Africa. Secondly, neuroscience, that does a lot of work in neuroscience areas. And it also in education, in engineering and other forms of science. So that's really where the focus comes. The Gatsby Charitable Foundation, it got the name because The Great Gatsby was David Sainsbury's favorite book.
Fantastic. I was wondering whether there was a link to film. I know you've worked in film financing, so I was trying to see if there was anything there.
No, unfortunately not.
Well, just in terms of moving on from there, can you tell us about then Orthogonal Partners had a wide range of next-gen alternative strategies, some of which were, I'm sure, in their infancy when you started to work on them, such as film finance and football finance.
Quite. Well, so the inspiration behind Orthogonal Partners is really to create a business focused on supplying institutions with truly non-correlated returns. When I worked at Lord Sainsbury's Family Office, although we had a very diversified portfolio by most people's standards, in times of stress, correlations still seem to move to one. So we really wanted to try and embrace strategies that were a bit more niche-y, that had perhaps different investors, because often it's the actual investor base that makes those strategies move towards one in times of crisis. And so we found lots of interesting first-time strategies that we embraced. And that often meant setting up a fund manager from scratch, helping them with their legal documentation, helping them with their strategy. And so, as you said, we covered some really interesting areas.
So you've had an interesting rotation through angel investing, family office investing, to managing your own firm and running a private credit program. What did those styles of investing teach you in particular, and how do you apply this today?
Yeah, I've had quite an unconventional career, and luckily I've been able to touch most corners of the alternatives world, spanning all those different areas. It's given me a great breadth of experience and a deep understanding of different asset classes, asset structures, and asset allocation. But if there's one lesson that stands out, it's that investment is all about the people, and that people drive everything across those different strategies and asset classes. And it's all about backing the right teams, understanding motivations, and ensuring the right alignment of interests. It's not enough just to have a great macro opportunity or a fantastic financial model. You really have to have confidence that the management team will successfully execute.
We're going to take a short break to hear from one of our sponsors of this series, Eagle Point Credit Management. I sat down with Tom Majewski, founder and managing partner of Eagle Point. I asked him one of the best ways to create value today.
One of the best ways to create value today, frankly, is taking a CLO that's probably halfway through its non-call period, maybe 2/3 of the way through. You can see 6 months out, you're going to be able to do a reset, maybe take a lot of costs out, maybe even take a dividend to the equity class. It takes a lot of work. It doesn't just happen automatically, but it's a way to create very real value today. And I think it's misappreciated in the market.
And now back to the show. Moving on then from there into the area of small and mid-cap investing. And that's actually how we met. We were at a dinner sitting beside each other and discussing the case for the UK. Can you tell us a little bit, set the stage for small and mid-cap investing in the UK? How did you first get interested in that?
Yeah, I guess it's a natural career progression, given that I started focusing on UK angel investment. Then I ended up underwriting fund managers that were focused on venture capital, growth equity, and lower middle market opportunities. So I've had a long awareness of SME opportunities and inefficient markets. And I've always been drawn to those kind of inefficient markets where there's a scarcity of risk capital rather than a wall of money. And that's exactly what you see in the UK SME market, particularly at the lower end and away from the high growth, high scale up businesses in technology and pharmaceuticals. There's been a long-running structural funding gap in UK SME. Mark Carney famously said that there's a £22 billion funding gap for UK SME. And the government's recognised it, and that was part of the reason why they formed the British Business Bank to try and help bring money into the space. But I suppose I really got focused on it when Darwin Alternatives approached me with an idea to back Enterprise Investment Scheme graduates. For those that aren't aware, the Enterprise Investment Scheme here in the UK is a government-backed tax relief programme designed to encourage investment in early-stage, high-risk companies. And since the mid-1990s, EIS schemes have backed 37,000 companies in that space. The idea was to identify businesses that had successfully proven their model with this initial backing from EIS and were ready for the next phase of growth for us to come in. We never quite got there together, myself and Darwin at the time. It was partly my fault as I was offered a fantastic role to head up a private credit business in an established asset manager, which I turned to. And while at that private credit manager, I worked closely with several direct lending managers in the UK SME space. I actually completed a joint venture with one of them. And that experience convinced me there was a better way to participate in UK SME, which combines both credit and equity, so that you can kind of get the best of both worlds, the downside risk mitigation of being in the credit, but the upside of having some equity. And so I approached Darwin with this idea around 2023, and they were still interested in launching a new fund. And so I joined as a strategic advisor with the aim and purpose of helping them create this strategy and launch it.
And how would you sort of rate the opportunity set today? The reason I'm asking is because the UK has, just from a macroeconomic perspective, there have been some negative outlooks attached to it. It has, from the post-Brexit reality to lack of investment in the UK, which has been highlighted by the government, the Department of Pensions, that there's been a lot of focus on the need to invest in the UK and a recognition that many institutional investors are not, at least not in the stock market piece of it. How would you say the opportunity set stacks up in light of all of that?
Well, I think the opportunity set is vast. There's no doubt that UK SMEs have had a really tough time with it. First, you've had Brexit, then you've had the cost of living crisis, you've had inflation, you've had the energy crisis, you've had higher interest rates, but there's still pockets of really good companies that are out there. I estimate that there's about 17,000 companies in that kind of 2 to 6 million EBITDA range. Overall, there's 5.6 million SMEs in the UK. They account for 99% of all businesses. They employ 16.7 million people, which is effectively 60% of private sector jobs. And they have a combined turnover of £2.4 trillion, which is half of all private sector turnover. So it's a really massive space. And the reach and resilience of this sector make it a powerful driver of regional and national growth. But, as I've said already, they remain chronically underfunded, particularly at the smaller end of the market. And the bank lending to SMEs never really recovered from the financial crisis, with the major banks kind of retreating. And while alternative lenders and private equity firms have stepped in, much of that capital is focused on the higher growth venture style businesses or larger mid-cap firms. And there are some alternative lenders such as peer-to-peer platforms or crowdfunding firms or things like asset-backed lending, but they're just dwarfed by the supply of opportunity. So I think there's a massive opportunity to step into this gap and make a genuine difference by investing in modestly growing but successful enterprises that are embedded in their local communities. This is about the kind of builders and the consistent growers, the manufacturers, the service providers, and regional businesses that are contributing to their local economies. Every investment that we would look at would have a backstory: a family firm preparing for the next generation, a local employer increasing operations and looking to expand, or a founder looking to take some money off the table. But these are the kind of quiet achievers embedded in their local communities. And I think you can take an old school private equity approach to this space, taking a disciplined underwriting approach, building strong relationships and offering hands-on support can really make a difference.
Is there any particular type of business? I'm thinking, just to name something that comes to mind, given I know Darwin's focused on say, funeral parlors or something like a bereavement services. I'm thinking plumbing services, cafes, insurance brokers, any kind of sector that you think is particularly overlooked, underfunded?
Like I said, I think there's a lot of areas that are underfunded, particularly outside of the tech space and the pharmaceutical space. we look at case by case examples. So we have a wide network of regional advisors, tax advisors, brokers, corporate finance houses that will bring us deals. And we really look at this from a bottom-up perspective, looking at whatever comes to us. We don't really take a top-down asset allocation approach. But I think there's a really big opportunity, as I said, to focus on companies that have modest growth, but that are established, that have been around for a while. They've got proven financial models. They've got diverse customer bases, but they need a little bit more money to take the next step. And I think that's where we can really make a difference.
And how would you say, I mentioned already the government emphasis on regenerating parts of the UK, certainly stimulating investment in the UK. How does your style of investing, is this where they're focused, do you think, on the SME sector, or would that square with this momentum?
I think there's a clear desire from the government to push UK investors into domestic investments, and a desire to shift UK pension capital away from global equities back to domestic investments. And I think our strategy is a fit for that, because we're deploying primary capital into UK SMEs that are critical for job creation and regional growth. By providing flexible capital, we're not just generating returns, we're helping businesses expand, create jobs, and strengthen UK PLC from the ground up. That directly aligns with the government's push for productive finance and regional economic development. We're supporting family-owned businesses. What there is a slight institutional challenge, though, in the sense that the government's trying to consolidate further the pension fund industry and create these very large pools. And that makes it very difficult for them to allocate to smaller opportunities such as ours. And it kind of pushes them towards large infrastructure projects or larger investments. And I think the danger is there that you end up with a market beta return rather than being able to go out and generate alpha, which is often in these more niche areas.
And another area has been, it used to be called leveling up, but the idea of seeing some of this investment go regional, be spread regionally to enable regions that may have been underappreciated, overlooked, to have some investment. Is your investment focus broad-based across the UK? Do you have any particular regions that you focus on?
We will go wherever the opportunities are. It's very clear that London gets a lot of the inward investment. We're very keen to go outside of London, and actually it's smaller UK SMEs are often in the regions. They're not necessarily in London. And I think that's a very easy way of helping level up by supporting these local community-based companies that have been in their communities for a long time.
Now, just moving to ESG factors, how much does that factor into your thinking? And are you looking at sustainability of these businesses? Are they in a position economically to even pay attention to that?
It's definitely an important part of our thinking and investment process, but we take a practical, value-driven approach. It's not a box-ticking exercise, and we don't market ourselves as an impact fund or an ESG fund. But a fundamental aim is to make SMEs stronger and more resilient. And that naturally involves improving governance, sustainability, and responsible business practices. We will avoid businesses in sectors that have obvious ESG risks like tobacco or gambling or arms. But beyond that, our focus is on making good businesses better rather than excluding them outright. For us, ESG isn't really it's not about an ideology, it's about risk mitigation and value creation. Well-governed businesses with strong leadership and sustainable growth strategies tend to be worth more. Darwin's a signatory of the UK Stewardship Code and aligns itself with the UN principles of responsible investment, and has a track record of actively enhancing ESG credentials of its portfolio companies. And obviously, we'll be looking to do the same in all the companies that we invest in.
We're going to take a short break to hear from one of the sponsors of this series, Benefit Street Partners. I sat down with Rich Byrne, President and CEO of Benefit Street Partners, and asked him what his decades in the financial services industry, as well as being a decorated jiu-jitsu champion, has taught him about the meaning of life.
Life is filled with opportunity. You need to go out there and, like they say, again, I'm being very corny today, but they say the biggest regrets are not the things you did and failed, they're the things you didn't do. I think it's about getting on a frequency. When you find something that interests you, just get into that frequency. And it's amazing when you're doing something you love and you dedicate yourself to it, you can achieve incredible things.
And now back to the show. And just an aspect of ESG is diversity, social side. And we do speak on this podcast a bit about having diverse boards, diverse industries, diverse organizations. Any thoughts on the diversity of finance in general?
Well, clearly some progress has been made in broadening access, but the industry is still very much dominated by a narrow demographic in terms of gender, ethnicity, and socioeconomic backgrounds. However, I'm not really a big fan of positive discrimination. I think there really needs to be, and it's a need for meritocracy, hiring based on talent and potential. But if it's a marginal decision, go with the candidate that's going to improve the diversification of the organization, I think. The real change, I think, is not just about hiring, it's about career progression and retention and making sure that the diverse talent that you have actually gets a seat at a decision-making table and gets promoted. It's not just about widening the talent pool, it's about making sure that the talent pool or the talents that you do have can make a step up. If you think about women in the workplace, they're still the primary caregiver. They still tend to take the burden on of looking after children. And so what we need to do is make sure that businesses are open to flexible working arrangements for those people. You know, you need to maybe encourage flexibility around remote working or having flexibility around core hours. I've seen incredibly talented and experienced women sidelined, not because of their ability or work ethic, but simply because they made a reasonable choice to prioritize their family at certain points in their careers. And that's a terrible waste for everyone. At the margins, diversity can be a competitive advantage. Broader perspectives can lead to better decisions and resilient businesses. And so I think diversity has its place to play, but you can't just force people in at the expense of sacrificing the best people.
Really well said. I think it's certainly a debate that is live right now and that we're sort of watching the nuances evolve, maybe counter to some of the rhetoric. I'd love to move on to some personal reflections now. You've had quite a lot of exposure to some interesting, as it was having worked in the family office at Lord Sainsbury's and there at Darwin as well, some real thought leaders in the investment landscape. Has there been any in particular that have had an influence on you and how you see the world, how you think about investing?
I guess clearly at the beginning of my career, working for a couple of sharp entrepreneurs like Anil Varma and David Jennings helped spark an entrepreneurial spirit in me, and they had a big impact on myself. And then working at the family office, I was able to work with really good people, really clever investors. But I think I have to give a special mention to Romik Pavlovich, who actually was part of the hiring team at the Sainsbury family office. He's been a key person in my career. He convinced me to join him at Orthogonal Partners as a founding partner. And he's always pushed me to reach beyond what's comfortable. And so he's been a key figure in my life. But then, you know, going back prior to my career, I have to start with my parents. Growing up, I was extremely fortunate to have parents who believed in me and they supported me at every step of the way. And that foundation gave me the confidence to take risks throughout my career. And particularly because I've always felt there's a safety net there for myself. And I think a lot of people don't have that privilege.
Working with angel investing, clearly there's going to be a high loss ratio there. Similarly, in some of the SME investing, I think it's not venture capital investing as we talked about, but there's going to be some wins, some hits and some misses. Would you say there were any setbacks or challenges in any of this investing trajectory that you learned lessons from?
Yeah, absolutely. I think when I look across all asset classes and I look at my investment career, the biggest lesson I've had to take is regulatory risk. I've seen really good investments fall apart, not because the business model wasn't solid, but because there's been an unexpected regulatory shift, and that's changed the game overnight. A classic example is when I was investing in football players. What we would do is we would lend money to a football club, take a basket of their players, and when those players moved on and were transferred out, we would receive a realization. Well, in the middle of that strategy, the government outlawed third-party ownership, as it was described then. And so that meant that the strategy overnight became very difficult to execute. Similarly, in patent infringement, this was a really interesting area, but under Obama, they introduced the American Invents Act, which made it very hard to enforce IP against big technology companies. In this case, we had a portfolio that was worth maybe 20, 30 times what we had invested on paper anyway. And then overnight, it went right back down to basically par. The other thing is, I guess, is that people misbehave. and they don't necessarily follow legal contracts. And I think one of my biggest lessons is that it doesn't matter how good your legal contracts are, how watertight they are, they're not worth very much if it costs too much to enforce them. And so I guess you can't rely on legal contracts, and you have to make sure that you get into bed with people you trust. You go back to what Harry Markowitz said, the Nobel Prize winner. Diversification is the only free lunch in investment. And I think that's really true because it protects you against these kind of idiosyncratic risks or systemic risks even.
It's really interesting what you say about people doing the wrong thing. How do you then, I guess you will, that you only learn that through experience and I suppose maybe trusting in advance where you maybe should not. How do you get the balance right there? Because obviously there has to be an element of trust as well. So do you just kind of file those experiences away in terms of making yourself a little maybe less naive as you approach each next transaction or interaction?
Yeah, there has to be an element of trust. And otherwise you wouldn't have done a deal with someone in the first place. But I think you can inspect your governance structures that you have in place, sitting on boards or having someone that you trust sit on those boards, have non-execs in place that answer to you rather than answer to the company. I think particularly when you're investing in funds and you have offshore directors, they tend to be compromised a little bit. Or should I say, that's perhaps unfair, but there is a conflict of interest in that they're being paid by the investment manager who's hired them to act in that way. And I think it's important in those circumstances, certainly we felt, to get our own independent guys on those boards so they could be our eyes and ears and see what was going on.
Really interesting. And then my last question is around any advice you might have based on whether some of these experiences or earlier in your career, any words of wisdom that you can leave us with?
Something I wish I had taken more seriously at the beginning of my career is the power of networking. I would tell my younger self to build those relationships from the start. Working for Lord Sainsbury's family office or working for the angel investors, there wasn't really any pressure to work relationships because people were coming to you. But actually, networks open doors and they give you diverse perspectives and they're invaluable. So I'd tell my younger self to focus on those. And also I'd say it's fine to take the unconventional path. There's a lot of pressure on people to follow a conventional path. And I think trust your instincts, embrace the uncertainty, and get comfortable with discomfort. Rewarding opportunities often come through risk and initial struggle.
And I would think nowhere is that struggle more visceral than in a SME,
Yes.
which certainly I think probably is in the trenches every day, kind of blocking and tackling, just to mix a few metaphors there. Well, thank you so much, Dan. Since we met, I knew I wanted to hear more from you because I think there are few and far between investors who are committed to this segment of the market, and particularly in the UK. I think it's very easy to overlook this area. And I think it is important to have champions and advocates and supporters who are on the ground, finding the opportunity, funding that opportunity, and allowing it to see the light of day and to thrive. So thank you so much for the work you're doing and for coming here to share your insights with us.
Thank you very much for having me on the show.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.